When scholarships, grants, and federal student loans are not enough to cover the cost of attending school, many students are faced with the option of taking out private student loans and obtaining a cosigner if needed. Other times, private student loans may simply be listed on a federal financial aid awards letter without any real distinction that it's not a federal student loan. Hi, I'm Karina Mendoza from the University of Wisconsin-Madison Division of Extension with today's UW Mindful Money Moments. I continue our conversation on student loans by focusing on private student loans. Private student loans are any student loans that are not funded by or issued directly from the U.S. Department of Education. Private loans will not have the names of specific federal loan programs like the Federal Perkins, Federal Family, Direct Loans, and so forth. On private loans, the federal government does not determine the interest rates or repayment terms, nor does it subsidize the interest, which means the government does not pay the interest on the loan while you are in school at least half time or during your first 6 months after leaving school, your grace period. Instead, private student loans are funded by banks, credit union, state loan programs, the colleges or schools themselves, or any other type of company or institution. Private student loans generally have variable interest rates, which means the interest rates can reset or change every month or every quarter, causing your monthly payments to change over time, making it difficult to budget correctly or to know the actual cost of the loan beforehand. And it requires you to be more active, to read the fine print and become aware of some of the business practices meant to extend the life of the loan to keep you paying interest. Some private loans at first glance look like they have lower interest rates. However, with the variable interest rates and fees, a private loan can end up costing significantly more. Therefore, be careful when comparing loans. Take your time reading the cost of taking out a private student loan and play around with the loan payment calculator offered through the individual lender, finaid.org, or studentaid.gov. Also, a cosigner is often required on private student loans because the student may not have the proper length of credit history needed to take out the private student loan. No matter how the lender defines cosigner, a cosigner is a person who guarantees to take on equal responsibility and legal obligation to repay the loan. A cosigner will have to repay the loan if the student borrower does not repay the loan. It is a guarantee to the lender, whether it be a bank, credit union, or any other institution, that the loan will be paid back plus interest. In taking out a private student loan, a borrower's credit history, along with the cosigner's credit history, is definitely taken into account when applying for the loan and determines the interest rate and terms of the private student loan. If a cosigner has a good credit history, the student may be able to borrow at a lower interest rate. But if they don't, the student may end up paying higher interest rates. Any late or missed payments for a co-signed loan will affect both the cosigner, and the student's credit history. It is a really big role for someone to take on. Before asking anyone to co-sign a private student loan or any loan, it is best to have a financial conversation with your potential co-signer and or significant financial supporter. Money and finances can be really challenging for many, but it doesn't have to be. In next week's UW Mindful Money Moments, we will talk about steps that you can take to have productive and healthy financial conversations about paying for post-secondary education. Until then, be safe and thank you for your time.